Hey everyone, welcome back to the Crypto Intelligence Portal with Covesting. My name is Nathan.
And I'm Liz. Today's topic, risk versus reward.
In theory, a risk-reward ratio is a simple concept. If a trader risks $1 to make $2, the risk-reward ratio is 1 to 2 or 0.5. The lower the ratio, the smaller the risk. If the ratio is above 1, then the trade should not be placed.
This ratio forces one to think in terms of risk and profit potential. Each element must be considered carefully in order to formulate trades. Risk is determined at the outset of the trade by using a stop-loss order. For example, a cryptocurrency is bought at $20 and a stop-loss order is placed at $19. That trader is exposed to $1 of risk per token. If they buy 100 tokens, their risk is $100.
A stop-loss should not be randomly set. Rather, it should be put at a price that shows where the initial trade prediction was wrong. By placing a stop-loss, level traders are making a calculated assumption that the price will continue to surge higher before it falls back through the area of support.
With entry point and risk determined, the reward is then evaluated. The reward is set using a profit target order. This is an offsetting order that closes the trade when the price reaches the profit target price level. Similar to stop loss, the profit target shouldn't be set at a random level either. It should be chosen based on normal market movements and trends. The logical place to put a profit target is just below the peak.
If a bigger move is expected, the profit target may be set outside the normal market movement. For example, a cryptocurrency is trading at $10, but based on upcoming events, it's believed that it could trade as high as $30. So the profit target should be placed at, you guessed it, $29. We suggest examining these questions to see if a trade is worth taking. Number 1, where is the entry point for this trade? Number 2, given this entry point, where should the stop loss be placed? And number 3, where does the profit target go for this trade and why?
Prospective traders should place a lot of practice trades in a demo account to see what works for them. Practice is also required to gain skill in choosing stop-loss locations and profit target levels. In conclusion, if the risk-reward is above 1, don't take the trade. If the risk-reward is below 1, then traders can consider taking the trade if it aligns with their trading plan and capital availability.
All right, everyone, we'll see you back here for the next episode at the Crypto Intelligence Portal.
Thanks for watching.